Good evening. Welcome to the weekly market wrap up. The Indian equity markets ended the week on a positive note with the BSE Sensex rising 2.6% and the Nifty rising 2.5%. The BSE Sensex entered the positive note in terms of year to date returns, rising 0.2% year to date, while the Nifty is still in the red about 0.5%. Good start to the Q2 FY23 results, but the banks, IT, and the FMCG stocks have maintained stability in the market, but the mid cap and the small cap companies were heavily impacted. The rise of the credit growth to a 10-year high of 18% year on year in October has added some value and momentum to financial stocks. The Indian equity markets seem to be performing well despite the global challenges, and the Indian equity market has proved relatively resilient too. The Indian equity have continued to extend their lead over most other major markets and are second best performing market this year after Brazil. India's inflation is also lower compared to most developed and emerging countries as data shows, and raw material price costs have started to cool off, which which has also helped in uh, easing off some of the trade deficit and aid corporate margins. Another normal monsoon, which was actually 6% higher and than your normal monsoon, will also keep food inflation in check, and the robust GST collection, currently at a 3-year CAGR of 13%, are some of the reasons why Indian market has been performing really well. India's inflation is lower than most developing countries, mainly due to the composition of its CPI index. Strong macro fundamentals, proactive monetary policies, strong balance sheets, relatively low external debt, and relatively high forex reserves compared to other countries are some of the reasons for the resiliency of this market. The Indian valuation premium to its Asian peers remains at an all-time high. The Nifty 12-year forward PE is at a premium to its long-standing average of around 18.5x, while the 12-month forward PB is also at a premium to its historical average of around 2.7x levels. In our opinion, we expect large caps to outperform the broader market competitors in the short term, while there are still some long term opportunities for mid cap and small cap companies. Companies that are specially dependent on domestic demand and those that are part of the input cost, those who can pass on the input cost pressure to the end consumer are in a better place and will outperform the market, in our opinion. While the valuation of several large cap stocks still seems higher and rich, most mid caps and small caps are relatively attractive. Though the mid cap valuations are trading at a premium compared to the global peers after such a rally, solid earnings growth for the second for this segment justifies the valuations to some extent. Uh, Coming further to the mid cap and the small cap indices, most of the stocks here are cyclical in nature. Let's say like logistics, real estate, auto anks, goods, and capital goods sector. Given the optimism that is around the cyclical industry and the government initiatives like the PLI, these stocks are could gain investor attention in the coming quarters. India as a whole continues to have great tailwinds like credit growth, real GDP growth, GST collections, PMI numbers, and low external debt to GDP ratio. India's weight in the MSCI Emerging Market Index has also increased, and India has overtaken UK as well to become the fifth largest economy in the world. Because of this, the profit pool for India, in my opinion, is increasing, which should lead to India getting share of investment inflows. Treasury yields still remain at a highest level since the global financial crisis, and upside risk to inflation due to a rise in crude oil prices and certain food items still remain. On a basis of external debt, India ranks around number 23 globally. However, the ballooning external debt in US economy is a looming risk for the entire market as a whole. That's it from my side for this week's wrap up. Have a happy Diwali and have a good evening. Bye.